Hello, everyone. This is Debra Richardson, and today I am putting the AP in Happy, where accounts payable teams are empowered to protect the vendor master file from fraud. This podcast will give a voice to accounts payable team members by talking about the growing reality of cyber attacks in their world and which vendor setup and vendor management techniques they can apply to protect the vendor master file from fraud. Need training? Visit the Vendor Process Training Center to enroll in your choice of weekly live and on-demand training sessions. Plus, get access to vendor setup form templates and reference tools that will help you and your team to reduce the potential for fraud, compliance fines, and just overall bad vendor data. So sign up for a free account to get access to free training sessions, vendor process FAQs, and a resource library with information you need to manage your vendor master file. Visit training.debrarrichardson.com today. The link will be in the show notes. An internal employee stole close to $15 million from Bridgestone over a 4-year period. And through investments made an additional $6 million. Did they get to keep it? And the way the internal fraudster was caught after they left the company. Also, what question should you ask of your vendor process? Keep listening. Welcome to episode 400. Employee makes $6 million from $15 million in stolen funds. Do they get to keep it? So I don't talk a lot about internal fraudsters, internal fraud, occupational fraud, but I really should because it happens often. And if you go on the Department of Justice, United States Attorney's Office, which is justice.gov, you can find all types of examples of employees that have embezzled from their employers. There's like no shortage of supply with that. And found one that was very interesting because not only did they embezzle the funds, but they invested what they embezzled and made money off of that. So let's get started with this former Bridgestone Americas employee. He was an assistant treasurer. And yeah, he pleaded guilty to $15 million in wire fraud. And so this is as recent as August 11, 2026. And this podcast will post or be published on Thursday, August 20th. So I actually do remember this being reported back in 2024, but the case hadn't gone through the courts yet. And now it seems like it has, although he still needs to be sentenced. So that's going to be December 22nd, 2026. And he does face up to 20 years in federal prison on each count. And I think he had 2 counts. Yeah, 2 counts of wire fraud. So anyway, even with that, and that is a lot. So if you're thinking about internal fraud, stirring, if that's even a word, don't do it because you eventually are going to get caught. And it comes with real prison time. And so, or it can come with real prison time. So let's get started on what this case was. So, first of all, who was the internal employee? And we are going to talk about who's the internal employee. Then we'll talk about how it happened. Then we'll talk about how they get caught, how they got caught, and then I'll give some recommendations on how it could have been prevented. And then I have a question for you to ask of your vendor process. So, again, who was the internal employee? So it was a person, I can't really pronounce their name, Saju Katawada, and my apologies if I am not pronouncing that correctly, but they were, or this person was 45 years old out of Franklin, Tennessee. And according to court documents, he worked at Bridgestone's corporate headquarters in Nashville from April 2016 until April 2024. And his most recent position was the assistant treasurer, capital planning and funding. And again, they worked at, or he worked at Bridgestone. So it sounds like that might have been a very lucrative position without the embezzlement. But yes, it happened. So let's keep going. And so he worked there from 2016 till 2024. And so, how did it happen? Well, he created a fake vendor. And not only that, but he went so far as to register a vendor in Nevada with that name, like registered with the state, but he put the name of a friend as the owner of the business. And so they don't say it in the write up, but I wonder whatever happened to the friend. But anyway. Actually talked about this on episode 395. Your vendors validations were successful. So why could it still be fraud? And what I talked about was how fraudsters, and I was really talking about external fraudsters, but internal fraudsters can do it too. How they set up or take over a state registration for a company so that when you do the validation, it appears as valid. So he must have known that Bridgestone looked at the state level records of their vendors, so they checked the state registration. And so, what did he do? He went and created one. Right. So that was the first step. I guess the first two steps: create a vendor with, or register a new vendor with your state of choice, in this case, Nevada, and then create a vendor record in the vendor master file. All right. And then the third step was to send fake invoices. And he did that for 4 years, 47. 47 invoices were paid over that 4 year period that totaled almost $15 million. Now, normally at this point, the DOJ, Department of Justice article, or you might also see it out there in a some type of an article in the media, will talk about what they did with the funds. They bought houses, they bought boats, jewelry, cars, and so you hear about that. But I don't see any of that in the write-ups, and I will put a link to the Department of Justice article, and then there's also another article from like the regular news. I'll put those as links in the show notes. But you don't hear anything. No one wrote about what he bought, what he used that money for. What it does say is that he did invest it. And so it looks like he transferred the fraud proceeds into financial and investment accounts that were under his control. And it ended up that that money generated more than $6.1 million in interest, dividends, and other gains. So he was actually very smart with these embezzled funds, and I'll say that again with emphasis: embezzled funds, in investing it. Well, let's now talk about how he got caught and then if he was able to keep it. So, how did he get caught? So, after he left in April of 2024, Someone in accounting noticed a decrease in bank service charges because that almost $15 million over the 4 year period was posted to service charges. And prior to me being in accounts payable, I used to be a controller. And as a controller, part of my position was to not only do the financials, but also the budget as well. And then I had to uh, create or generate a variance analysis for any of the actuals that exceeded or were severely or significantly under what was budgeted. And so, if you've been a controller before, responsible for the GL, you know that at closing time, you look at those expense lines. Actually, you look at the expense lines, revenue lines, everything to make sure that it is what you expected it to be. And if it's not, then you do a deep dive into, what hit that GL code, those expenses, that revenue to see if there's something missing or if something was coded wrong. And so that's exactly what was done. And when they looked at the interest expenses after he was no longer sending those invoices, then those interest expenses decreased. And so, what do you check? You check to see what invoices hit it in the past, and maybe that will alert you to an invoice that has not come in or was not accrued. So that you can make sure that you're posting things when they should be posted, even if you don't get an invoice, or maybe you got an invoice and it posted for a future period and it posted in the current period. And so you do that type of cleanup. And so someone did that with bank service charges. And guess what? They found the invoices that were coming from that fake vendor that he created. And it wouldn't take a rocket scientist to notice that because $15 million or almost $15 million over a 4 year period, that's almost $4 million a year, over 333,000 per month. And that is significant even for a big company like Bridgestone. So that's how he got caught. It did not take long because he left in April of 2024 and was arrested in November 2024. So I don't know if he assumed that he would not have to pay back the 6 million that he made off of investing the stolen funds or embezzled funds, but what it does say is that he admitted that the scheme generated approximately 21 million in total unlawful proceeds because he had not only stole the 15 million, but that 15 million made 6.1 million. So the thing that I get here, and this is definitely not funny for Bridgestone, but remember that scene in Goodfellas where Joe Pesci's character, Tommy DeVito, and Ray Liotta's character, Henry Hill, were in the restaurant sitting at a table, and they were all laughing about the fact that Tommy DeVito was telling this funny story, and uh, and Henry Hill was laughing so hard that Tommy DeVito stopped and was like, "You think I'm funny?" I mean, it's that I'm not the one to recreate that, but you guys probably remember that scene if you watch Goodfellas. Well, part of the dialogue of that scene was, "I don't know, Henry, you may fold under questioning," and that's what Tommy DeVito says. And so that's the first thing that I thought about when the Department of Justice right up here said that he admitted that he not only had the 15 million, but he had 6.1 million more. So who knows how that came about? But the question now is did he get to keep it? And the answer to that is again in this write up, and it is absolutely not. He has to forfeit $21 million in total. He owes the restitution to Bridgestone, totaling almost $15 million, plus interest, by the way, with the final amount to be determined by the court. So the almost 15 million plus interest, plus the $6 million that he made in interest, dividends, and other gains. So if you think that you might embezzle some funds. Number one, again, don't do it. It can carry real prison life at the federal level. And number two, if you do it and figure you're going to make money off of it, that money is going to be yours in the end. Absolutely, it will not be. Or in this case, it wasn't. And in this case, if it wasn't, then that means that in your case, it may not be either. Okay, so that did not end well. So let's talk about how it should have been prevented. And then we will end with the question that you need to ask of your vendor process. So, how should it have been prevented? And a reminder that he set up a vendor in the vendor master file. He submitted fake invoices for 4 years and he got paid. So it seems very, very simple. But the first thing is that he should not have been able to set up a vendor. If his position was assistant treasurer, capital planning and funding, that position should not be a position that should have access to add or change the vendor master file. And so I don't know if that was an issue with the security roles and access. It does say that he had various positions over the, 8 years, 20 from 2016 to 2024 that he worked for Bridgestone. So maybe part of those or part of the positions that he had was in the vendor setup and maintenance space. And so a lot of times it happens that as people move on, move up, leave the company, or I should say, stay within the company, but maybe move to a different department, they still retain their security roles and access that they have for previous areas. And that's something that definitely needs to be removed. They should only have security roles and access for their current position. And so, if that were the case, then a security role audit would have resolved that issue because they would have removed his access to create the vendor in the first place. Now, to be fair, the article does say that he created a fictitious vendor. That could mean that he, filled out all the paperwork, or if they have a portal where vendors register, he registered that fictitious vendor in the portal. And the reason that I say that is because he went so far as to register that vendor in a state. He registered the vendor in Nevada, and that must mean that at some point, something or somewhere, someone was going to do validations on that vendor, and he wanted to make sure that the vendor appeared real by being a registered vendor in a state. So it could be that he was not the one to actually create the vendor in the vendor master file, but by some way he posed as that fictitious vendor and either submitted the paperwork or uh, went into their portal and registered. So that could be the case. It may not be security roles or access. It may not be that issue. And if it wasn't a result of, lack security roles, then that's great. Well, it's great because, a process is being followed. It's not great because he was still being able to, or is still able to get set up. But the next recommendation should not have only caught that piece of it if he registered as the vendor versus creating the vendor record in the vendor master file. But it should have caught that and the fact that the 47 invoices, right, fake invoices were sent. And so again, this was a $15 million fraud over 4 years, and that's what 4 million, almost 4 million a year, which means it's almost $330,000 a month. And at that spend level, shouldn't there have been a PO for that vendor? Which means that there's going to be some due diligence, there's going to be, right, a contract involved. And at some point, that vendor should have been found out or identified as being fictitious. And so it does not appear that there was a purchase order for that vendor, no additional due diligence, no contract, only a vendor record and $15 million worth of invoices. Now, I will tell you, purchase order compliance is a thing. I know that is something that a lot of companies struggle with, where, spend over a certain amount should have a PO. Now, there are some types of spend that have exceptions. Whether bank service charges were one of them, I don't know. But in this case, and from you hearing about this case, maybe they should be part of your PO policy if they are not, right? That category of spend should require a PO. And so that should have identified this vendor as being a fictitious vendor. And then the last way I think it could have really been a deterrence is to add a vendor process audit. That means that for every, vendor that was set up, that was an existing vendor change, right? Anything that caused activity in the vendor master file could have been randomly selected, right, for an audit. And if it is not a valid vendor, then maybe that additional set of eyes could have identified that the process was not followed, because there's some way that that fictitious vendor, even if the employee did not set it up, if they submitted it via the regular processes, right? What was it that was missed that made that employee appear legitimate? Now, I know he did set the vendor up at the state level that normally requires a tax ID. And so maybe they were able to get a tax ID from the IRS. And so that might have been something that may have been caught, or that may have been a deterrence from or for the person, the guy that was the internal fraudster. Could have been a deterrence for him, since they know that they're looking at things, at activity in the vendor master file to make sure the process is followed. Now, what processes would have caught that? Well, it's again all in your vendor validations, making sure that you're verifying the vendor is real. But again, based on the podcast I just talked about, I think it was episode 395, about how these vendors are making the validations appear as successful. There still has to be other layers of control as well. And I love the fact that the PO one seems to be the best one, because it doesn't appear that there was a PO, and it doesn't appear that it was a contract, which would have brought in due diligence and other team members, either from the purchasing group, the sourcing group, whatever group handles contracts. It would have brought them in as well. And that is a deterrence from employee fraud. All right, so that was a huge fraud. He appeared to be very smart, but you know what? It still didn't work. And so, yeah, that leads me, though, to the question that I have of you and your organization, your vendor process. And that question is simply, could that have happened at your company? All right. With that, Thanks, everyone. I hope you enjoyed the 400th episode of the Putting the AP in Happy podcast, where accounts payable teams are empowered to protect the vendor master file from fraud. Don't forget to check the show notes for the links mentioned in the podcast. And if you enjoyed this episode, consider subscribing and writing a review of my podcast on the platform that you use to listen. Stay happy.